Did you know that you may see your tax rate spike in retirement due to a very specific tax trap? Now, this tax trap will cause your 12% marginal bracket to rise to 49.95%, an over 316% increase. Now, this is not some clickbaity headline. This is not some obscure part of the tax code that no one will be subject to. In fact, this is a very high-level retirement planning topic that unfortunately doesn't get enough attention. And it should get a lot more attention because a lot of retirees right now are facing this given tax hurdle without even knowing it, or will face it at some point in the future. And so in this video today, I'm going to explain, one, how this tax trap is created, and number two, how you can avoid it in your retirement. Now, as I said, this is a fairly high-level retirement planning topic, so I urge you to watch this video until the end. We will be building in a very intentional order so that this all makes sense. It's a confusing topic, but stick with me. And I promise by the end this will make much more sense and you'll be able to see how this translates to your retirement as well. So let's get into it. So this tax trap is essentially created by the coordination of two other tax traps that we've talked about in the past, in past videos. Now I'm going to link to both of those videos, but really the creation of this zone combines two double taxation zones and thus creates a triple taxation zone. So it's the combination of something called the Social Security Tax Torpedo, as well as layering something called the capital gain bump zone on top of this. But by the end of this video, I'm going to show you how the 12% marginal tax zone turns into 49.95% in retirement if you're not careful. Now, first let's talk through the Social Security Tax Torpedo, how that's created due to the complexities of how Social Security is actually taxed. Now, how much of your Social Security benefit will actually be taxed is determined by a very specific formula called provisional income. Now, I have an example on the screen right now. Don't tie yourself to this given example. This is a specific case that we just walked through this week for a given client. Your situation might be different. So the example that I have on the screen right now is a couple taking $65,000 of Social Security benefits. Now, they're over 72, so they're forced to take RMDs as well. Their RMD in this given year is $55,000, which means they have a fairly large tax deferred account. And they also have a relatively large taxable account as well that's generating $10,000 of long-term capital gains. Now, here's how the provisional income formula works. First, you take your gross income. Okay, this would include a lot of different line items. In this specific situation, it's going to include all the required minimum distribution, dollars that they were forced to take, as well as the long-term capital gains. Other things that would be included in here would be part-time income, pension income, rental income, basically everything that is going to be taxed at either ordinary income rates or long-term capital gain rates. From there, we're going to add in tax-exempt income. This would be muni bond interest. This gets added back into this provisional income formula, and then we're going to add in 50% of the Social Security benefit as well. And so if we plug this person's situation into this formula, we're going to arrive at a provisional income of $97,500. Now, your provisional income will likely look very different based on the different line items, taxable income sources that you have in your situation. Now, this provisional income number doesn't mean a lot to your retirement until you plug it into the given provisional income tables. And when you plug it into the table, you'll finally be able to calculate how much of your Social Security benefit is actually taxable. Now, if you're married filing jointly, you're going to look at this table right here. If your provisional income is less than $32,000, your Social Security benefit is tax-free. Okay, between this zone, if your provisional income falls within this zone, up to 50% of the amount within this zone is taxable. Now, we're fully through this zone, so we're going to have full taxability within this zone. 50% of this $12,000 range is going to be taxable. We see up here, this adds to our total Social Security taxability. Now, because our provisional income is $97,500, which is obviously over $44,000, we're going to take $97,500, we're going to subtract out $44,000, and then we're going to take 85% of that given value. That's going to be the taxability that we have in this 85% range here. So in this example, this is going to be $45,475. Now, our total Social Security taxability then is going to be $51,475. Now, let's say our provisional income was much higher, and thus this 85% taxability zone was raised. We had more taxable income within this zone. Well, at the very most, you can only have 85% of your Social Security benefit taxed. So if this, essentially this number skyrocketed up and was significantly higher, your Social Security benefit is capped at most 85% taxable. Now in this case, we're not yet 85% taxable, so we see how the numbers work out. Of our $65,000 Social Security benefit, $51,475 is taxable. Now, let's walk through a quick scenario here. Let's say that we had an extra $1,000 RMD. Okay, because we have an extra $1,000 RMD, our provisional income is going to rise by $1,000. And so what's going to happen here? Because it raises our provisional income by $1,000, it's going to cause 85% of that $1,000 to be added into Social Security's taxability. So essentially what happens here is something called the Social Security Tax Torpedo is created. Now, for simplistic sake, we're going to leave out long-term capital gains here. We're going to add that back in later in this given video. So now we're just looking at Social Security's taxability and looking at the given RMDs that we're forced to take. So on the x-axis down here, this is going to be taxable income from essentially traditional IRAs, whether it's an RMD or whether it's a withdrawal. On the y-axis here is going to be your marginal tax rate. And as you can see, as you start adding income from ordinary taxable accounts like your IRAs, we start to see that we have a rise in our marginal bracket here. So in red is intuitively what most people would think they're being taxed at. In blue is what you're actually being taxed at due to the Social Security Tax Torpedo. And what you see here is this 85% zone here that we see is created because of this Social Security provisional income table causes our marginal rate to rise by 85% in each of these given zones. Now, you may have a question of where's the 50% zone? Well, it's underneath the standard deduction over here, so we don't really have to worry about that in this person's given scenario here. But essentially what we're seeing here in layman's terms is as this person is taking a dollar from, let's say, a traditional IRA or from an RMD, it's forcing a portion of their Social Security benefit into being taxed. In this example, 85 cents is being taxed. And so there's a double taxation effect created here. A dollar being pulled from an RMD is causing a $1.85 to be taxed. Well, a $1.85 taxed at 10% means that your marginal bracket is actually 18.5%. A $1.85 taxed at 12% means that your marginal bracket is actually 22.2%. A $1.85 being taxed at 22% means that your actual marginal bracket here is 40.7%. This is how the Social Security Tax Torpedo is created. It's something I see not a lot of people focusing on, unfortunately, because it's such a critical tax planning tool in order to translate to tax savings in your given situation. You want to avoid this 40.7% zone. And so this is the first tax hurdle. We're going to stack another tax hurdle on top of this in order to create that 49.95% zone. But for 1 second, I want you to leave the Social Security Tax Torpedo, set it to the side in your mind, and now wipe the slate clean because we're going to be talking about a new tax hurdle and coming back to this tax torpedo here. The next tax hurdle we're going to be talking about is something called the capital gain bump zone. Now, it's very important to understand how the IRS stacks your income to deliver your given taxable income and tax liability. So first, the very bottom layer is going to be normally taxed ordinary income withdrawals. Things within this category would be traditional IRA withdrawals, pension income, RMDs, obviously, annuity income, Social Security would all be ordinary income taxed. From there, next you stack on capital gains, and then finally you stack on Roth IRA withdrawals. This is the ideal way that you would stack your income because, again, normally tax withdrawals are going to be your highest tax bucket. Capital gains offers a slight preferred rate, and then Roth withdrawals is obviously eliminating that very top end tax rate that you might be paying. Now we're going to come back to this given graph on the right hand side of the screen here to explain the capital gain bump zone here in 1 sec. But it's important to understand and manage these two given tax tables. And what I mean by two given tax tables is managing your ordinary income rates as well as your long-term capital gain rate. Now what you'll see here, specifically for someone married filing jointly, up to $83,550 of taxable income, they're going to be taxed at 10% and 12% in terms of ordinary income rates. But for long-term capital gains, they're going to be taxed here at 0%. Once they cross over this $83,550 mark, their long-term capital gains is now going to be taxed at 15%. Now remember, in terms of income stacking, capital gains are stacked on last. And so what's going to happen here is as you start to fill in your 10% and 12% brackets, you're going to be moving long-term capital gains from the 0% zone to the 15% zone, and you're going to see a spike in your marginal tax rate. We can see this on the right-hand side of the screen here. So we're looking at taxable income, so income after the standard deduction here. And so let's say you have taxable income coming from your IRAs of $83,550. Well, this is filling this 0 and 12% zone and thus pushing your long-term capital gains up into this 15% zone. And so we see here that instead of your long-term capital gains being taxed at 0%, they're being taxed at 15%. And so what's happening here with this last $10,000 of either withdrawals or RMDs that this person is taking, they are seeing a spike in their marginal tax rate. Because had they not taken that $10,000 of IRA withdrawals, their long-term capital gains would be at 0%. But instead, they're taking that extra $10,000 of IRA withdrawals of extra RMD that they're being forced to take, and it's pushing their long-term capital gains being taxed at 15%. So this extra $10,000 of IRA withdrawals has a marginal rate of 27%. Well, how do we find that? Well, because this extra $10,000 of IRA withdrawals is being taxed at 12%, but it's also moving an extra $10,000 of long-term capital gains to be taxed at 15%. And so their marginal rate here, their marginal bracket spikes to 27%. And now when we start to layer this inside of the Social Security Tax Torpedo, this is where this perfect tax storm is created. So we're looking at the same Social Security Tax Torpedo graph, but now we're adding in that third bucket here, that taxable account bucket. And so right off the bat, what can we see? Well, previously the 40.7% zone happened right when we started crossing this 22% zone. But because of adding in long-term capital gains, we actually move it into this 12% zone. And we see rather than being taxed at 40.7% or 22.2%, because of the stacking of these given tax hurdles here, we see that your marginal rate rises from 12% up to 49.95%. Now, how is the math? How does this work out math-wise? Well, let's walk through it together. Okay, so again, just for a reminder here on the left-hand side of the screen, I have the ordinary income rate and capital gain rate zones for married filing jointly. And we have a scenario here where this person is in the 12% bracket, let's say right on the edge of this 12% bracket right here, and they are having an extra $1,000 RMD, or maybe they're taking an extra $1,000 IRA withdrawal. Now, intuitively, they think, okay, that $1,000 is going to be taxed at 12%. I'm going to owe $120 in a given tax liability. But what actually happens is, yes, they are correct that that $1,000 RMD is taxed at 12%, but they're only looking at about half of the equation here, or a third of the equation, if you will. Again, because of the Social Security Tax Torpedo, that $1,000 RMD is going to raise their provisional income by $1,000 and thus move $850 of their Social Security benefit to now being taxed once again at 12%. So that's going to cause another additional tax liability of $102. But again, if we remember what's happening here, that $1,000 RMD is raising their taxable income by $1,000. That $850 of Social Security income is raising their taxable income by $850. And so when they're on the edge of that capital gain bump zone, they're having an extra $1,850 of taxable income that's filling up and giving that tax base and thus pushing long-term capital gains into also being taxed. So it's going to push $1,850 of their long-term capital gains into now being taxed at not 12%, but 15%. Which is going to translate to $277.50 of in total long-term capital gain tax liability. And so when we add those three line items together, we get a total tax of $499.50, all off of a $1,000 withdrawal. So pretty easily we can translate this into a marginal tax rate by taking $499.50, dividing it by $1,000 for that given RMD, and we see a 49.95% marginal tax rate. Now, there are a couple of very important details to understand here. First off, the Social Security Tax Torpedo, this given chart is custom to everyone, meaning that based on how much you have coming from Social Security, based on if you're a single filer or a married filer, based on how much income you have coming from other places as well, it will change what this given tax table looks like. And so you have to generate this for yourself or have a trusted advisor that generates this for you for tax planning. The other thing to note is those provisional income marks of $32,000 and $44,000 for a married couple. Those thresholds haven't changed since 1986, so those don't adjust to inflation. So what you're going to see is if you're not yet being taxed inside of this Social Security Tax Torpedo, slowly over time your income will slowly drift into being taxed here because your Social Security benefit will adjust to inflation. You'll likely take out more for RMDs. You'll likely take out more in taxable income sources due to rising income need due to inflation. And so what you'll see is you're slowly pushed further and further into the Social Security Tax Torpedo. The other very important thing to note is the size of this bump right here is going to be completely determined by how much long-term capital gain you have coming in. So if you have, let's say, $50,000 of long-term capital gains, you're going to see a bump zone that is extended, that is larger, and thus will change the dynamics of this given Social Security tax trap combined with the capital gain bump zone. So there are a few important details to understand. We went through some simplistic examples here. But again, this is a fairly high-level retirement planning concept. But as we can see here, it's completely worth the extra work to put into trying to avoid this given tax torpedo. Within retirement, we will rarely see a marginal rate, especially when we leave out certain tax cliffs. We will rarely see a marginal rate that's higher than 49.95%. Now, this is just based on federal income tax brackets. So if we, again, add in state income taxes, for many retirees, we're actually going to be above a 50% marginal tax rate zone. And so if you're having a little bit of trouble understanding what's exactly happening here, it all stems from a concept that we often talk about in retirement called a chain reaction effect, where changing one variable, taking one set of income, can have a chain reaction of affecting 5, 10, 20 variables down the line. And so this is exactly what we're seeing here. This person is taking in a given RMD. Now, intuitively, this is where most people stop their line of thinking. They think, I'm just taxed on this RMD. But we know after going through these given examples, that's not exactly the case. That RMD is having a chain reaction effect of forcing more of their Social Security benefit into being taxed. Well, more of their Social Security benefit into being taxed, as well as more of their RMD being taxed, is forcing them into this capital gain bump zone, which is pushing more of their long-term capital gains into now being taxed at 15%. That creates this tax hurdle that will spike your marginal rate 316% higher, from 12% all the way up to 49.95%. It's also important to note that in 2026, when the Tax Cuts and Jobs Act expires, these brackets will look that much worse, because rather than being taxed at 12% here, you're being taxed at 15%. And so how can we avoid this in retirement? Well, the first thing is we need to control our taxable account. Now, we've previously recorded numerous trainings on this, around 5 taxable account rules for more tax-efficient investing inside of your brokerage account, your joint account. Now, the problem with most retirees is they don't have control over their taxable account. It's a fairly leaky bucket because they don't control the dividends that are coming from that account. They're invested in mutual funds, and so they have long-term capital gains being distributed from that account that they don't have any control over. So the first thing is gaining control over that taxable account to try to only have long-term capital gains when you decide to have those long-term capital gains. The second thing is make sure you have a forward-looking tax plan. This is a must in retirement. What I mean by this is rather than at the end of the year taking your shoebox full of receipts into your CPA and saying, what can you save me? At that point, it's already too late. The reason for this is because the moves that you make at the beginning of retirement will affect the next 20, 30, 40 years, however long your retirement lasts. And so we need to be planning for the future at the beginning of retirement, planning for years 10, 20, and 30, and making sure that we're dealing with the tax issues now instead of waiting, procrastinating, and just being forced into these tax issues. As you can see, if we have an RMD that we're forced to take, if we have a taxable account that we're forced to take taxable income from that taxable account in any given year, we might be forced into this tax torpedo and capital gain bump zone intersection without anything that we can do about it. And so have a forward-looking tax plan that lays out your tax liability through time, can identify where we estimate you're going to be subject to this given destructive tax trap, and avoid it earlier. Don't procrastinate. So hopefully this video was informative, showed you about a very destructive tax zone that you can avoid if you're a little bit more strategic in retirement. Always remember, you don't need more money, you need a better plan. Thanks for watching. If you found value out of this video, please hit the like button down below. It's free for you and means quite a bit to us. Also, hit the subscribe button. It'll help notify you of all future videos that we release. We release videos on a weekly basis for how you can improve your retirement. Have a great rest of the day. Thanks for watching. We'll see you in the next video.